Okay, let's get right into it. We are looking at the futures market today.
Hmm.
And while, most people think this is just about predicting what happens next, the sources paint a very different picture.
They really do.
It's not really about prediction. It's about locking the future in.
Exactly. It's the ultimate double-edged sword. And to get why this matters, you have to look past the spot market.
Right, that's just paying cash or something right now.
It is. Futures are different because they're a centralized, regulated arena where you agree to a transaction that settles, well, later. You're divorcing the decision from the actual exchange.
Which brings us to the futures contract itself. This isn't just a handshake deal.
Oh, not at all. It's a highly standardized legal agreement.
So whether it's crude oil or corn or even the S&P 500, the contract spells everything out.
Yeah.
The asset, the expiration date, the size.
And that standardization is the secret sauce.
How so?
Because every contract is identical, they're perfectly fungible. It allows, say, a trader in Tokyo to trade with a farmer in Iowa instantly.
Without ever needing to inspect the goods.
Right. It turns raw materials into financial data points that can just move at the speed of light.
Now, there's this common fear one I see pop up all the time about physical delivery.
Ah, yes. The idea that a truck is going to dump 1,000 barrels of oil on your lawn.
Exactly.
Yeah.
But looking at the data, that almost never happens. Most of this is played through cash settlement.
Precisely. You're just exchanging the difference in value, not the actual asset.
So if you bought oil and the price jumps $10.
You get that cash credited to you. You don't need a storage tank.
Yeah.
And because you aren't moving physical goods, the capital efficiency is just off the charts.
And that efficiency creates the most powerful and dangerous mechanic in this whole system.
Not the leverage.
This is where the math gets wild. You don't put up the full value of the contract.
Nope. You just post an initial margin.
Which is like a good faith deposit.
That's a great way to put it. It's usually only, 3 to 12% of the total contract value?
Think about that. You can control $100,000 worth of crude oil for maybe $5,000 in cash.
And if oil goes up 5%, you've just doubled your money. That's the allure.
But the flip side is the maintenance margin. If the market moves against you, you get a margin call.
And a margin call in the futures world isn't a polite request. It's a demand for cash now.
And if you don't wire the funds,
The broker liquidates your position instantly. You don't get to wait for a rebound like you might with a stock.
because of mark-to-market accounting, this is a critical concept.
It is. Stocks settle when you sell them. Futures settle every single night.
It's basically real-time scoring, but with real money.
Every single day. If you lost money, that cash is physically removed from your account balance tonight. If you made money, it's added. It is brutal, daily accountability.
So who's actually playing this stressful game? We have two main camps, right?
Broadly speaking, yes.
First, you have the hedgers. These are the players using the market for its original purpose. Risk management. Like the farmer from our notes.
The short hedger. They're selling corn futures today to guarantee a price for their harvest later.
So they give up some potential upside just to know they won't go broke if prices crash.
And on the other side, you have the long hedgers. Think of an airline buying oil futures to lock in their fuel costs. It's their insurance policy.
But what if the farmer wants to sell and no airline wants to buy at that exact second?
Ah, that's where our second group comes in. The speculators.
The scalpers, the day traders,
Yeah.
the grease in the gears.
Exactly. They provide liquidity. They take the other side of the farmer's trade, absorbing that risk. They don't want the corn, they just want the profit.
And they're incentivized to do this by a fascinating tax rule, the 60-40 rule.
This was a huge find in the research.
It really was. So, regardless of how long you hold a contract, even for 5 seconds, 60% of your profits are taxed at the favorable long-term capital gains rate.
Which is a massive structural advantage compared to trading stocks.
Yeah.
It basically subsidizes those liquidity providers, but, and we have to stress this,
That tax break doesn't matter if you blow up your account.
which brings us right back to leverage. It cuts both ways. A 10% move in the wrong direction can wipe you out completely. Zero.
So the market is efficient, liquid, and tax advantaged, but it has zero tolerance for error.
It's a zero-sum game, really. For every dollar won, a dollar is lost.
So we have a system that lets global industries stabilize their costs while offering speculators these high-risk, high-reward opportunities.
It's the engine of global pricing. Without it, the price of your cereal or your gas would swing wildly. Futures smooth that out.
I want to leave you with one final thought based on that mark-to-market idea we talked about.
Mm.
We're used to seeing our home value or our 401k go up and down, but it's just paper gains or losses until we sell.
But imagine if real life worked like the futures market. Imagine if every evening a bank official came to your house. If your home's value went up, he hands you cash.
But if the housing market dipped,
He reaches into your wallet and physically takes that cash out before you can even eat dinner. That is the relentless reality of the futures trader.
something to think about.
Yeah.
That wraps up this deep dive. Thanks for listening.